We welcome our viewers to the March edition of Monthly Fixed Income Outlook. We have with us Mr. Kaustubh Gupta, our fund manager on the fixed income side. Welcome, Kaustubh.
Hello, ma'am.
So, Kaustubh, first we would like to know that post the last monetary policy announcement, what are the key developments on the macroeconomic front and what should investors expect in the next monetary policy?
Since last monetary policy, we have now a data on the growth numbers for Q3 GDP. The numbers was somewhat lesser than what market consensus was at 6.3% for GVA and 6.6% for GDP. Resultantly, the CSO has revised for FY19 growth target to about 7% from 7.2% earlier. Even the high frequency indicators, they are painting somewhat of a mixed pictures, but clearly post September 2018 we have lost some kind of momentum on the growth front. Headline inflation, which came at 2.05%, was clearly on the lower end of RBI comfort zone of plus minus 2% of 4% median range. What was more heartening in this data is core inflation, which led by education and health came on the lower side. With food inflation, which continues to be in negative print as of now, it looks like that for next few months, the headline inflation print will remain as per the policy path which is envisaged by RBI. On global front, the data continues to be on the softer patch and looks like that the global economic activity has loosened the steam for now. Thus, in nutshell, we can say that both domestic and global factors are allowing RBI to continue to maintain a accommodative stance for now.
So, Kaustubh, like you mentioned, there is a scope for further monetary easing in the April policy now.
Yes.
But in the month of March, usually short-term rates spike up, and similarly, short-term funds start looking viable to invest in.
Yes.
What are your views on that?
So, this is a seasonal phenomenon as the advance tax amount goes to the government, and in order to achieve the fiscal deficit target, government shore up their cash balances. The resultant is that banking system liquidity, it moves to large amount of deficit number. For March of 2019, we expect that banking system liquidity will close about 1 to 1.25 lakh crore deficit. But come April, when government gets new budget and they start spending again, we expect that over next 3 months, these deficit numbers will move to large amount of surplus, somewhere about 80,000 crores to about 1 lakh crore positive. Now, in March, because the banking system liquidity is deficit and the demand for the money goes up, the corporate bond spreads and money market paper spreads over repo, it shot up, and which is the case now that they are quite elevated. Thus, they provide reasonable accrual opportunities for investors to come and lock these rates. More important, if RBI cut rates by 25 basis point, which is widely anticipated by the market, there is a opportunity to have potential capital gains in them also. When RBI cut rates, it is the short-term rates which have a maximum impact, and thus we think that up to 3-year point, which is from money market papers to 1 to 3-year corporate bonds, they are likely to have maximum impact of these rate easing cycles. Thus, we invest in these papers, and we would suggest investors to look under the funds which do invest in them.
So, Kaustubh, in light of this, which are the funds you would recommend our investors to invest in right now?
All these funds which do invest up to shorter end of the curve up to 3 years, I would rank them in the order of ultra short term fund, money market fund, low duration funds, corporate bond funds, banking and PSU funds. These are category of investor funds which invest in broadly AAA corporate bonds and money market papers, and which likely to have maximum impact when RBI cut rates. Even if RBI doesn't cut rates, there is reasonable amount of accrual which is there, and investors should benefit from them once the liquidity moves from deficit to surplus zone.
Thank you, Kaustubh, for sharing your views. We thank our viewers for being with us. Happy investing.
Thank you, investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.